Before a piece of heavy machinery can be depreciated, it has to be conceptually translated from a physical object on the factory floor into a structured data object on a balance sheet. This data object is categorized as property, plant, and equipment, or PPE. To qualify, these assets must be tangible. They must have an expected useful life greater than one reporting period, and they are initially recorded at their historical cost. Historical cost is highly specific. It captures the net purchase price of the asset, plus every directly attributable cost required to bring that asset to its intended location and get it operational. If you pay for shipping, installation, or assembly, you add those dollars directly to the asset's capitalized cost. But the accounting boundary is strict, particularly for real estate. When constructing a new building, the costs of preparing the site do not attach to the building itself. Expenditures for clearing trees, draining swamps, and grading the earth are permanently capitalized to the attached land account, not the facility sitting on top of it. This practice scenario illustrates how the boundary is tested. When isolating the correct amount for the land account, we take the initial purchase price, the legal closing costs, and add the $6,800 spent on clearing and grading. We strictly exclude the $4,300 spent digging the foundation, because that attaches to the building. The rationale comes down to the concept of useful life. Land has an indefinite useful life, meaning it cannot be depreciated. If you commingle site preparation costs into the building account, you will eventually depreciate those costs over time, corrupting your entire expense schedule. The final historical cost is a highly curated aggregate, the absolute ceiling for every dollar of expense recognized over the asset's entire life. Once that initial capitalized cost is locked in, the accounting process shifts from day one capitalization to the ongoing mechanics of subsequent measurement. This formula dictates the cost hitting the income statement over its life cycle. We begin with the historical cost boundary, subtract the salvage value, the expected residual amount recovered at disposal. This leaves the depreciable base, the absolute maximum expense allocated over time. Depreciation, therefore, is an algorithm for the systematic and rational allocation of this exact base. It does not measure physical wear and tear, nor does it track market valuation. It dictates the timeline of your reported profitability. To understand how different algorithms alter that timeline, we will use a single control asset, an industrial robot with a historical cost of $1 million, a salvage value of $100,000, leaving a $900,000 depreciable base across an estimated 5-year useful life. The most common allocation model is straight-line depreciation. It is a default time-based method that operates on the assumption that the economic benefits of the asset are consumed evenly over time. This table shows the mathematical execution. Notice the first column. The $900,000 depreciable base remains perfectly consistent for every single year of the asset's life. Next to it, the denominator stays completely static at 5 years. By dividing the fixed base by the fixed time, the algorithm produces a flat depreciation expense of $180,000 every single year. Tracing the carrying amount down, the math lands the asset's final book value exactly on the $100,000 salvage target. Straightline provides maximum predictability and smoothly levels out reported earnings. However, if the robot actually sees heavy physical use early on and breaks down later, this flat algorithm completely fails to match the operational reality. If a company wants to mirror that physical reality, they abandon time-based methods entirely and use usage-centered activity methods. Under these algorithms, the calendar clock is irrelevant. We adjust our control variables. The 5-year estimate is discarded. Instead, the asset's life is strictly defined by an estimated lifetime output, in this case, 8,000 units. This chart illustrates how fluctuating production writes the expense schedule. In year 1, we divide the 2,300 actual units produced by the 8,000 lifetime capacity to create a unique fraction. Applying that fraction to our base yields a year 1 expense of $258,750. Because utilization was high early on, this charge is significantly larger than what the straight-line method produced. But as the robot ages and production tapers off to 100 units in year 5, the associated expense shrinks drastically to $78,750. Look at the column totals. Despite the extreme year-over-year swings, the sum of all recognized expenses caps mathematically at exactly the $900,000 depreciable base. This units of output method achieves precise matching between revenue-generating activity and asset expense. The trade-off is that it introduces significant volatility to the income statement that external investors will have to digest. For companies that want to front-load their expense recognition while still using a time-based model, they turn to accelerated depreciation. These methods intentionally generate massive early charges that decrease over the asset's life. The first major model is double declining balance, or DDB. Its mechanical rule is straightforward. Apply a constant percentage rate to a steadily declining carrying amount. But this calculation reveals the major trap of the DDB method. It breaks the standard depreciable base rule on day one. The starting calculation ignores salvage value completely and begins with the full $1 million historical cost. We then apply a 40% rate, which is derived by taking the 20% straight-line rate and simply doubling it. That produces a massive year-one expense of $400,000. Subtracting that charge from the initial asset value physically reduces the starting balance for year two down to $600,000. If we follow this constant rate against a declining balance down to year 5, we hit a mathematical anomaly. Because DDB ignored the salvage value up front, applying the 40% rate in year 5 would drop the asset's final carrying amount below its $100,000 floor. To prevent this, the algorithm forces a hard stop, plugging in the exact remaining amount, $29,600, to reconcile the balance sheet. Double declining balance is an aggressive formula that prioritizes early expense drops, even if it requires a clumsy mathematical plug in the final year to fix the initial setup. The alternative accelerated method is sum of the year's digits, or SYD. Its mechanical rule is the exact inverse of DDB. Instead of applying a constant rate to a declining balance, SYD applies a declining fraction against a constant base. This table demonstrates a return to standard capitalization rules. The depreciable base column is locked precisely at $900,000 for all 5 years, properly deducting the salvage value from the very beginning. The acceleration is handled entirely by the fraction. The denominator is 15, which is the literal sum of the digits of the asset's 5-year life, 1 plus 2 plus 3 plus 4 plus 5. The numerator is then counted backward. We multiply the fixed base by 5/15 in year 1, 4/15 in year 2, forcing the acceleration. This yields a year 1 expense of $300,000. It is a highly front-loaded charge, though slightly less severe than the $400,000 drop we saw under double declining balance. Both algorithms achieve the exact same goal of acceleration, but their engines are entirely opposed. DDB front-loads expense by shrinking the carrying amount, while SYD achieves it by shrinking the fractional multiplier. This graph visualizes the financial impact side by side. Regardless of the path taking, every line perfectly converges at the $100,000 mark in year 5. Now, look at the gap between double declining balance and straight line in year 2. The difference in recognized expense is massive. These diverging lines represent strategic financial incentives. Accelerated methods heavily suppress early net income, which can create valuable early tax shields if permitted by the tax code. Conversely, straight line artificially props up early reported earnings by delaying the expense recognition. In all 4 scenarios, the actual physical robot on the factory floor is identical. It is only the financial representation that has been altered. Eventually, the initial depreciation setup gives way to the reality of the post-deployment lifecycle. Operating heavy equipment requires constant mid-life cycle expenditures just to keep things running. Expenditures during an asset's life fall under strict rules. A capital expenditure must do one of 3 things: materially improve the quality of services, significantly extend its useful life, or increase its overall output. These specific costs are capitalized, directly altering the depreciable base. In contrast, a revenue expenditure handles the routine, recurring costs made simply to maintain normal service capacity. These bypass the balance sheet entirely and are expensed immediately on the income statement. This specific question tests that exact boundary. Look closely at the phrase, expenditure to install an improved electrical system. Because the text specifies an improved system rather than a repaired one, it qualifies as a betterment. This triggers capitalization rules, forcing us to return to our day one logic and add that cost to the depreciable base. Failing to properly classify a revenue expenditure as a capital one artificially inflates current period net income and violates the core matching principles of accounting. At the enterprise level, tracking the life cycle of a single robot is straightforward, but major corporations manage tens of thousands of depreciating assets simultaneously. To process this volume, entities rely on group and composite depreciation methods. These algorithms apply straight-line math to massive collections of assets, treating groups of dissimilar equipment with varying lifespans as if they were a single unified asset. The mathematical elegance of grouping is that it relies on the law of large numbers. It intentionally accepts that the overestimated useful lives of some machines will perfectly offset the underestimated lives of machines that break down early. Whether you are allocating clearing costs to a land account on day one, selecting between competing acceleration models, or auditing a mid-life cycle overhaul, these frameworks determine the timeline of profitability. Mastering this capitalization boundary allows financial professionals to accurately translate physical reality into compliant financial strategy.